let's kick off with a look at the overall market. As I said, just coming in above that 3,300 point mark. It has been a bull rally for the markets as the earnings season is firmly underway now. Do you think that the market has more legs to push higher from here?
I think so. I think in the coming weeks or in the coming week, momentum will be driven by Equity Bank and probably Cooperative Bank that are yet to release the results, and we could see increased position taking on this. And from where we stand at the moment, we think the market is currently undervalued with regards to not only price earnings but forward price earnings if you're taking to consideration a 3 to 5 year horizon. And I think once sentiment turns back, then we could see the rally being sustained. But in the short term, I think the earnings announcements, especially from Equity, Cooperative Bank, and probably Standard Chartered, could drive further momentum forward.
Let's just glance back to results that we saw out last week. Kenya Commercial Bank, which is of course the biggest bank by assets, really set the tone in the banking sector. Really strong results coming through there. But just reading some of the commentary, there's a lot of concern around its intention to push its loan growth, especially in the SMME space, given the fact that the NPL ratio in this space is higher than other competitors. Are you concerned about its more aggressive strategy in the banking sector right now?
Well, I think for one thing is that the bank has really rejigged the managerial structure of the organization, and I think it would be, it is clear to the current management of the threats they are facing, and I think they have the capacity to deal with those threats. Indeed, the SME space is tricky, especially with regards to defaults. But I think the current management is in place, is in the position to analyze their risk and mitigate those risks through different measures. So I wouldn't put so much of a threat on NPLs from the SME sector, because I mean KCB know what they're doing, and I think that their strategy will pay off. And besides, historically KCB has been dealing with NPLs of around 20–30%. And so they know how to handle the risks.
And of course, that's really their speciality. Another bank that knows how to manage, or is said to know how to manage the risk in this small to medium enterprise space is, of course, Equity Bank. We've got results out of them this week. And in the meantime, the IFC is said to be extending 100 million shilling loan to boost lending to the sector. What does that mean? What does that 100 million shilling loan mean for Equity Bank right now?
For one, it's a further vindication of their market strategy, and for one thing is that IFC and other multinational organizations have been coming through Equity Bank to extend their loans, and it means that they have the strategy and have the infrastructure in place to extend those loans and to boost productivity within the economy. So it is a vindication of their work so far, but also going forward in terms of profitability, it means that Equity can benefit from low deposits or low cost funds through IFC, which are usually at interest rates of around 2%, and extend them at decent rates to the SME space and benefit from the difference. So I think it's two-pronged. It's first a vindication of their work so far, and it's a source of low cost funds that will boost profitability going forward.
Very quickly, before we move on out of the banking sector, between Equity and KCB, do you have a preference between those two stocks?
I wouldn't say I have a preference. I think both of them are doing things right clearly, as you can see from the results. KCB, of course, first of all, from growing their PBT by 54%, and also having a 330 billion shilling balance sheet. And also Equity Bank, given their quarterly results so far, they're doing some things right, and I wouldn't have a preference. In fact, I'd have both of them in my portfolio.
So both stocks to add. Let's take a look at some other results that we saw coming on Friday. BOC Kenya, strong results there, 90% earnings per share growth to 7.70 shillings. Yet the stock fell back by just over 3% on the day. What's weighing on the counter? What other results did investors not like?
I think there are two things. For one, despite EPS growth of 80–90%, turnover grew up by only 4.3%. So from the top line, they don't seem to be doing as well as expected. And I think the bulk of the EPS growth was due to cost cuttings. And maybe when you get the clear results or more detailed results, we will be better able to analyze that. But top line growth was sluggish. Secondly, they have a high dividend payout ratio. And I think for investors looking at a company like BOC, you'd expect a bit more aggression in terms of growing the company. If you look at the infrastructure space in East Africa, this is a sector that is really growing fast. And I think investors would want to see more investment in CapEx and the likes to grow profitability going forward. So I think those are the two key issues that are holding back BOC stock at the moment, well, at least in my view.
But what about the growth opportunities that the East African region present for the company right now? Because it is looking to grow in Tanzania, especially in the natural gas sector, of course, and mining. Uganda, it's focusing on oil, healthcare, agriculture. So it does have plans in the East African region, yet of course these plans need to materialize. But do you buy into the restructuring plans from management at the moment?
No, I think if they are really focusing on growth, then they wouldn't have as high a dividend payout ratio as they had. For one, last year they recapitalized their reserves by giving a special dividends of 6 shillings, and this year they had a dividend payout of around 88–89%. So indeed, even if they were looking at growth opportunities, I think one way to capitalize on these growth opportunities would be to retain more funds. So from a financial perspective, I don't think they are, in my view, strategizing towards more growth this year. I think it seems that they're just like PAT, they're comfortable with where they are, and that's why they're just paying out all their profits in dividends.
Let's just take a look at the MPC decision tomorrow. Before I let you go, Samora, we've got mixed views from analysts in terms of whether we are going to have a cut this time around or not. Of course, we had inflation ticking down to around 16.7% in February. So that provides of course, some evidence that we could have an interest rate cut right now. But is it too soon, from your view, to be cutting the repo rate?
It's a tricky situation at the moment for the MPC. For one, indeed, there are a lot of factors that point towards the rate cut. For one, inflation was down to 16.6%. So we've had 3 consecutive months of disinflation at the moment. And so that would be a pointer towards at least some monetary easing. However, there are other noises that will play into that decision. For one, you'll have the currency that's still, at the moment, supported by the current interest rate environment. And I think the CBK would look to be extending those gains for a while longer. Secondly, globally, there's the issue of the Iranian standoff and the impact on crude prices. So at the moment, the consensus for disinflation is not as strong as it was maybe 3 months ago. And I think, if anything, there could be probably at most a 50–100 basis point cut in the CBR, but not as strong a cut as investors would like to see. So that's my position at the moment. If any change in the CBR, it will be very minimal, if any, at the moment.
So maximum we're going to see is that CBR coming down to 17% is basically what you're saying. We'll leave it there for today. Thanks so much for joining us this morning, Samora Kariuki, research analyst from NIC Securities.